Companies in the American middle market continue to be the strongest point of growth in the U.S. economy. But having delivered a bang-up performance in the third quarter of 2015, they're also expressing markedly greater caution about the outlook ahead. I'm Tom Stewart, the Executive Director of the National Center for the Middle Market at the Ohio State University Fisher College of Business, and I'm here to present our third quarter 2015 Middle Market Indicator. The Middle Market Indicator, the MMI, is a pulse check for the economies that make up the middle third of the private sector in the United States. That's about 200,000 companies with revenues between $10 million and $1 billion a year. Every quarter we survey 1,000 executives who are representative of the middle market in terms of company size, geography, and industry. We ask them, how's business? How's their performance? How's their top line? How's their bottom line? What are their payrolls like and their hiring plans? What are their plans for next year? What are the obstacles, challenges that they face? And what's their confidence in the U.S. economy? The data for this MMI were collected in September 2015. Here's what we learned. Let's start, as we usually do, at the top with revenue. Middle market companies delivered 7.2% average revenue growth in the 12 months ending with the third quarter of 2015. That's a very strong number. It's the third highest number we've seen in the 3.5 years in which we've been collecting these data. It's also a step up from the 6.6% annualized growth we saw in the quarter before. Now, the S&P 500, those large companies, also delivered pretty strong growth, 4.7%. But the middle market typically delivered revenue growth more than half again as great as that of the S&P 500. And, although it's sort of apples to oranges, the middle market's revenue growth, annualized with the third quarter of 2015 at 7.2%, was faster than the growth of the GDP of China. It's the first time we've ever seen that. But should we exult? Probably not, and I'll tell you why in a couple of minutes. But first, let's look at job growth. Job growth in the middle market was also quite robust. Middle market payrolls are 4.1% larger than they were at the same time last year. That's a tad higher than job growth last quarter and higher than job growth in both the S&P 500, it's 2.5 times higher than job growth in the S&P 500, and also higher than job growth among small businesses. But again, it's no reason to break out the champagne, and let me tell you why. First, we see continued strong confidence in the national and local economies, but plunging confidence in the global economy. For the first time, more than half of middle market executives say they do not have confidence in the global economy. Now remember, I told you these data were collected in September after some rough months of news from Asia and the Middle East. And remember that the middle market is mostly focused domestically. But global conditions affect a key subset of the middle market and indirectly affect everybody, whether it's through raw material costs or tourism revenues or things like that. It's noteworthy to point out that 3 of the 4 most important trading partners of the middle market, Canada, Mexico, and China, are facing slower growth. We're seeing slow growth conditions in India, Brazil, and many other places as well. So that's caution signal number 1. Caution signal number 2 has to do with overall corporate performance, which includes the top line, the bottom line, profitability, everything added up. 63% of middle market executives say that their overall performance is higher this year than it was 12 months ago. Now that's the lowest number we've seen in a year. Only 5% say that conditions are worse, the rest say conditions are unchanged, but when you see people seeing that the rate of their gains is going down, then they tend to hold back in their investment. So that's caution sign number 2. And caution sign number 3 is what they actually say about their investment plans. Every quarter, we ask executives, if you had an extra dollar, would you save it or would you invest it? This quarter, the percentage of savers jumped from 33 to 37%, back to a level that we saw about a year and a half ago. Now, if you dig into those numbers and look at specific questions about expanding into new markets, opening a new plant or facility, adding a new product or service, we don't see much change there. but we do see a promise or a statement from middle market executives that they're going to reduce their level of overall investment. How seriously should we take this forecast? We've noted before that middle market executives tend to deliver more than they predict. They tend to outperform their forecasts. This quarter we went back and measured that difference. They tend to underestimate job growth by about a percentage point and underestimate revenue growth by about 1.5 points. But even adding those numbers back in, we see them projecting slower growth on both the top line and in jobs than before. Indeed, for the first time, only 49% of middle market companies are actually expecting their revenue to grow in the next 12 months. When it comes to job growth, their overall prediction is for 3.2% job growth, which is a pretty strong number, but it seems to be concentrated in a relatively small number of companies, for only 36% of companies say that they expect their payrolls to expand. Now, these are caution signs, not alarm bells. Sometimes companies enjoying a good year sit on their wallets to protect their profits through the end of the year. The political campaign and the coming election year, again, can cause companies to take a wait-and-see attitude when it comes to certain investments. There was, as I said, this stock market volatility and bad news from global markets in the summer, and that may be a blip, or it may not work its way deeply into the real economy where the middle market lives in the United States. And finally, this recovery has gone on a long time. It's now the 6th longest recovery in U.S. economic history, and as a recovery goes on over time, the rate of growth is likely to flatten out, even while growth may continue. So let me add it up. Growth, job growth, revenue growth, overall profitability were very strong in the 12 months ended with the third quarter of 2015. Going forward, middle market companies are expressing caution in all of those areas, in their investment plans, in their plans to add to payroll, and in their expectations for their top-line growth and profitability. At the same time, the middle market continues its important role as the growth engine of the U.S. economy, and therefore truly as the growth engine of the global economy. So watching how these trends play out over the next few months is going to be extremely important, not only for those executives, but for everybody who lives and works in this country and abroad. Our website, middlemarketcenter.org, presents the entire middle market indicator and all the data, including that which I've highlighted here. It also has all our historical data from previous middle market indicators and much more research from the National Center for the Middle Market about the U.S. middle market companies. There's no charge for any of it. So please visit middlemarketcenter.org, and thank you very much. I'm Tom Stewart.